Greetings, boys and girls. Welcome to the weekly economic update on a Tuesday. Yesterday was Memorial Day. Hope everyone had a fantastic weekend and hope y'all did some fun stuff. I was pretty lazy, just watched a lot of baseball. And like I said on my Friday broadcast, we went out to see a movie on Friday afternoon, but that was about it. So, like I said, hope everyone had a great weekend. If it's your first time watching, give me a big old thumbs up, a subscribe, a like, a share, all that good stuff. Um, all right. Not a great day in the markets, but again, this is not unexpected for those playing along and watching on a regular basis. This is certainly not anything to be caught off guard about. All right, well, let's go ahead and jump into today's numbers. The Dow Jones was down 0.67%, closed at 32,990. The SP 500 was down 0.63, closed at 4132. NASDAQ was down less than those, down 0.41, closed at 12,081. Small caps are down about 0.81%. The VIX climbed today. It was up 1.83%. It's currently sitting at 2619. Moving on to the other Americas, Canada was down 0.91, Brazil up 0.29, Mexico down 0.79. Heading over to Western Europe, I see mostly red. Germany was down 1.29. The UK was basically flat at up 0.1. France was down 1.43. The Euro stocks was down 1.36. Netherlands was up 0.64. Spain down 0.89. Italy down 1.22. Switzerland down 1.06. Portugal down 0.6. Belgium down 1.35, Austria down 105, Sweden down 1.57, Denmark down 1.29. Heading over to the Russian exchanges, both of them were down. The MOEX was down 1.86, the RTSI down 0.84. All right, let's head on over to the Asian markets. Japan was down 0.33, Australia down 1.03, New Zealand was up 0.8. And it looks like all the Chinese markets are up more than 1%. The Shanghai was up 1.19. The SESE component up 1.92. The China A50 up 1.57. The DJ Shanghai up 1.22. And the Hang Seng up 1.38. And the Taiwan weighted came in at 1.19. So, yeah, it looks like the Asian markets were pretty good. Mostly reds across Eastern and Western Europe with a few. Let's see, was that the Netherlands was a major bright spot in Europe, and then here in the U.S. Or in the Americas altogether, Brazil was the only one that looks like it was up. So not great, but again, it's to be expected. I mean, we've been looking at this long-term trend since really since January or the beginning of the year, and until we break that trend, I really don't see a need to make any adjustments as far as adding back more equities into the mix. Depending upon what you folks are doing out there on your own, I would be careful. That would basically be my best advice right now. All right, well, let's go ahead and jump into this week's weekly economic update. And let's see, let me make it a little bigger so I can see it. All right, the week on Wall Street, stocks gains for the week buoyed by the release of the Federal Reserve minutes and upbeat earnings from midsize and discount retailers. The Dow Jones Industrial Average jumped 6.24%, while the SP 500 advanced 6.58. NASDAQ was up 6.84, and internationals rose 2.09. A good week. The stock market staged a broad rally last week, ignited by the release of minutes from the May's FOMC meeting. The meeting notes erased concerns that the Fed might pursue a more aggressive monetary tightening stance than the street had anticipated. Investor sentiment rose owing to solid earnings and encouraging guidance from several midsize and discount retailers, which eased concerns about the health of the American consumer. A smaller rise in personal consumption expenditures price index, the Fed's preferred measure of inflation, triggered a strong rally on Friday. The powerful move ended 7 straight weeks of stock losses. Fed minutes. The minutes from May's FOMC meeting were released last week. They confirmed the likelihood of at least 2 consecutive 50 basis point interest rate hikes. The minutes also indicated they might need to raise rates to a level that acts to restrict economic growth, something that Fed Chair Jerome Powell acknowledged might be a painful process. It's kind of like going to the gym when you haven't been to the gym in a while. First time you get on that exercise bike or the treadmill, you think you're dying. So you get through it, drink some water, you'll be okay. Not all Fed members are fully committed to the more aggressive rate hikes. Last week, Atlanta Fed President Raphael Bostic wrote that a pause in interest rate increases in September might be appropriate. He joined other members in suggesting that the economic conditions may warrant reconsideration of additional rate hikes beyond those already signaled by Powell. Again, the people at the Fed and the people in big banking hate high interest rates because it crushes their margins and it makes everything it makes growth stocks not look as good on paper at as of right now. So anyways, all right, economic data coming out this week. Today is consumer confidence. Wednesday is the ISM manufacturing index and the job openings and labor turnover survey. Thursday we have ADP employment report, jobless claims and factory orders. And on Friday, we have the employment situation and the ISM services index. Companies that are reporting earnings this week. Today, on Tuesday, we have Salesforce, and HP. Tomorrow, we have MongoDB. Not sure what that is. Thursday, we have Broadcom, Hormel Foods, chili, DocuSign, and CrowdStrike. All right. So that's everything in the weekly update for this week. Got one white paper that's going out with the newsletter for those on my mailing list. And if you'd like to be on my mailing list, just send me an email and say, hey, add me to your weekly mailing list. I'd be happy to do so. All right. Creating a retirement strategy. Across the country, people are saving for for that someday called retirement. Someday their careers will end. Someday they may live off their savings or investments, plus Social Security, if it's still there. They know this, but many of them do not know when or how or how it will happen. What is missing is a strategy. A good strategy that might make a great difference. A retirement strategy directly addresses the when, why, and how of retiring. It can even address the where. It breaks the whole process of getting ready for retirement into acceptable steps or actionable steps. I'm sorry. This is important. Too many people retire with doubts, unsure if they have enough retirement money or uncertain of what their tomorrow will look like. Year after year, many workers also retire earlier than they had expected. According to a 2022 study by the Employee Benefit Research Institute, about 47% do. In contrast, you can save, invest, and act on your vision of retirement now to chart a path toward your goals and the future you want to create for yourself. Probably not a bad idea to plan ahead. Most people put a lot of effort into planning their vacations and they never even put any effort into planning for their retirements. It is kind of sad. Since it's impossible to predict the future, some people dismiss having a long range retirement strategy. Indeed, there are things about the future you cannot control, how the stock market will perform, how the economy might do. That said, you have a partial or full control over other things: the way you save and invest, your spending and your borrowing, the length and arc of your career, and your health. You also have the chance to be proactive and prepare for the future. A good retirement strategy has many elements. It sets financial objectives. It addresses your retirement income, how much you may need, the sequence of account withdrawals, and the age at which you claim Social Security. Probably best to take it late if it's still there. Again, I don't have much hopes for guys like me in their 40s, but for those who are in your 60s and 70s, may not want to plan on living too long. But it should be there for at least a few years. Where was I? It establishes or refines an investment approach. It examines financial implications and possible healthcare costs, as well as the transfer of assets to heirs. A prudent retirement strategy also entertains different consequences. Financial professionals often use multiple probability simulations to try and assess the degree of financial risk to a retirement strategy in case of an unexpected outcome. These simulations can help inform the financial professional and the retiree or pre-retiree about the what ifs that may affect a strategy. They also consider sequence of returns risk, which refers to the uncertainty of order of returns as an investor may receive over an extended period of time. Let a retirement strategy guide you. Oh, yeah, this is just an ad down here at the bottom. Says to reach out to a financial professional if you want some help and guidance with that. I might know somebody. Call me. I'll let you know. All righty. Well, let's go ahead and jump into today's market recap. Dow falls, but Ekes win in May as rocky ride continues. The Dow fell Tuesday, but capped off another volatile month with a gain as investors weighed up the strength of the consumer at a time when the Fed is facing pressure to put the screws to inflation. Amazon led consumer discretionary higher, rising more than 4%, despite Jefferies trimming its price on the e-commerce giant to 32.50 from 3700, citing concerns about an economic slowdown. Consumer confidence in the economy, however, hasn't deteriorated as much as expected. The conference board's measure of consumer confidence fell to 106.4 in May from 108.6 in April, beating economist forecast for a reading of 103.9. Consumer stock sensitive to China, including Nike and Starbucks, were also in ascendancy as Shanghai ended its 2-month COVID-19 lockdowns. Tech, meanwhile, ended off lows of the day amid a mixed performance with big tech following pressure from climbing treasury yields. So when treasury yields go up, not a good thing. It hurts those growth stocks. Alphabet and Apple were higher, while Microsoft and Facebook ended the session in the red. Energy cuts in gain. Energy cut its gains after oil prices slipped on reports that some OPEC members are considering suspending Russia's participation in the oil production deal. This could potentially pave the way for other OPEC members, including Saudi Arabia, to increase output. The news comes as Russia's crude output is expected to fall after the European Union agreed on a ban on Russian oil imports. In other news, AMC Entertainment fell less than 1% after giving up some gains despite signs of a return to movie demand following a record setting weekend. Box office performance by Top Gun Maverick. Did any of y'all go out and watch that? I did not. I cannot. I do not enjoy military movies, and it's like watching Top Gun now or when I was in the Navy. It was just awful. You notice all the flaws, and again, being an OCD kind of weirdo that I am, I notice every little thing from how they salute to how they stand, everything. Um, and quite frankly, no one would be that reckless with I mean, the F-18s 20 years ago when I was working on them, they were I think 30 million out the door from McDonnell Douglas, then Boeing. I think they bought them at that time, but I can't imagine what they cost today. I mean, probably 50 million each and fully armed with, missiles and bombs and all the good stuff. I mean, it could probably, I mean, there's probably $100 million worth of crap on those things when they're flying off the cats. But anyways, yeah, I don't know. I'll probably watch it when it's on cable or whatever. But yeah, I have zero desire to watch Maverick. And the other big thing is, I mean, I was finishing sixth grade when Top Gun came out. So let's just say Lieutenant Pete Mitchell at the time was, in his first squadron headed off to Top Gun for advanced fighter training. And so in that time, I've finished middle school, high school, 4 years in the Navy, and all these years beyond. And so, or I guess now he's Captain Mitchell. He never made Admiral probably because he was a screw up. And, he would be pushing 60. So, I mean, like I said, if he was in his mid 20s, when he, in the mid 80s, 35 years later, I mean, he'd be a 60-year-old, captain, which I don't remember seeing a lot of those. They get kind of tenured out by that point. And anyways, all right. The positive end to May for the broader market followed a wave of disappointing quarterly earnings from retailers earlier this month, showing the inflation squeeze on lower end consumers and stoking fears that Fed's plan to slow growth could tip the economy into recession. But some on Wall Street suggests that while economic growth will likely slow, bets on a recession will prove overblown. Really? I mean, remember all that transitory inflation talk last summer? Yeah, that was a lie. We believe fears of declining economic activity this year will prove overblown unless new negative shocks materialize, said Goldman Sachs in a note earlier this week. All right, so that's everything there. Got some, I guess we'll call it good news about the dollar. The dollar is rising again. I don't know if that really says a lot about the dollar or if it says more about uh, you know, the the weakness of the other currencies that the dollar is rated against. So, all right, the U.S. dollar strengthened across the board on Tuesday as Treasury yields climbed, and worries over further acceleration in global inflation depressed investors' risk appetite. The dollar was supported by demand for safe havens. U.S. Stocks fell on Tuesday as soaring oil prices and hawkish comments from the U.S. Federal Reserve officials spooked investors. U.S. Treasury yield. U.S. Treasury yields climbed on Tuesday, a day after Fed Governor Christopher Waller said the Fed should be prepared to raise interest rates by a half a percentage point at every meeting from now and until inflation is decisively curbed. Christopher, I like what you have to say there. That is a solid plan. Raise the interest rate until inflation recedes. And maybe some deflation would be nice too. I think a lot of people would like to see prices actually go back down as opposed to just stop growing. Because I don't know anyone who wants to pay $4 gas, in perpetuity, or the cost of goods at the store. Anyways, all right. The U.S. dollar currency index, which tracks the greenback against six other major currencies, was up 0.3% at 101.76, on pace for its best one-day gain in nearly 2 weeks. The dollar index, up about 6.4% for the year, is down 1.4% for May, on pace for its worst monthly performance in a year. President Joe Biden told Fed Chair Jerome Powell on Tuesday that he will give the central bank the space and independence to address inflation as he sees fit, according to a top aide. Yeah, most of these presidents want to get reelected, so they'll. I mean, Trump did the same thing, that Weasley Cheeto. Back in 2019 when we were trying to reduce the balance sheet of the Fed from the quantitative easing from the previous meltdown back in the aughts. The market had a temper tantrum, or they called it a taper tantrum, and we lowered interest rates again and stopped. Basically put a halt to all that because it was making the market not react the way they wanted. So Tuesday's bounce in the U.S. dollar suggests better support for the dollar index around its 50-day moving average, which the index has been testing over the past couple of sessions. Sean Osborne, chief currency strategist at Scotiabank, said in a note. The dollar index has not closed below its 50-day moving average since mid-February, but has drifted closer to it over the last several sessions. Quote, we think the USD is unlikely to rally significantly and still consider price action to reflect the early stages of a broader reversal in the recent U.S. Dollar bull trend, Osborne said. For now, the euro remained weak as data on Tuesday showed Eurozone inflation hit a record high in May, adding pressure on the European Central Bank as it fends off a recession and looks to curb high prices with gradual interest rate increases in the coming months. Inflation in the 19 countries sharing the euro accelerated to 8.1% in May from 7.4% in April, beating expectations for 7.7% as price growth continued to broaden, indicating that it is no longer just energy pulling up the headline figure. Well, it starts with energy, and then from energy, it spreads out into the economy because everything uses energy, whether or not it's driving goods around the country or shipping them on trains or in the warehouses, the electricity to, keep temperature at its, where it needs to be, and the lights and everything else. So everything starts with energy, and when energy is expensive, like it is today, it floats out into the rest of the economy. So again, not to be surprised. So that's why, in my view, until we see energy prices recede, we're really not going to see a lot of help, at the cashier. News that European Union leaders agreed in principle on Monday to cut most oil imports from Russia by the end of the year sent oil prices higher and offered some support to commodity currencies. The Canadian dollar touched 1.2653 per dollar, near a 1-month high, struck overnight ahead of Wednesday's Bank of Canada meeting, at which all 30 economists polled by Reuters expect a 50 basis point rate hike to 1.5%. In cryptocurrencies, Bitcoin climbed 1.39% to 31,666.45, a near 3-week high. All right. More good news. Rising costs of living hurts U.S. consumer confidence and housing prices soar, written by Lucia Mutakani from Reuters. U.S. consumer confidence eased modestly in May as persistently high inflation and rising interest rates force Americans to become more cautious about buying big-ticket items, including more motor vehicles and houses, which could curtail economic growth. The survey from the Conference Board on Tuesday also showed consumers' perceptions of the labor market softening a bit this month. Though the drop in confidence was small, it suggested that the Federal Reserve's aggressive monetary policy actions to slow demand were starting to have an impact. Quote, we never underestimate the U.S. consumer, end quote, said Jennifer Lee, a senior economist at BMO Capital Markets in Toronto. Quote, but plans to pull back on purchases and become a little more cautious is something that the Federal Reserve would welcome as it aims to cool demand, end quote. So, I mean, yeah, the Fed would love that if consumers just stop spending. That'd be great because it would slow down the economy without them having to raise interest rates. Unfortunately, I just don't see that. People are going to have to get a little slap on the hand first before they pull away from the cookie jar. All right, the conference board's consumer confidence index slipped to a reading of 106.4 this month. The data for April was revised higher to show that the index at 108.6 instead of the previously reported 107.3. The index remains above its pandemic lows. It has fared much better than the University of Michigan survey, where the consumer sentiment index is at an 11-year low. The conference board survey puts more emphasis on the labor market. The survey's so-called labor market differential, derived from data on respondents' views on whether jobs are plentiful or hard to get, fell to 39.3 this month from a reading of 44.7 in April. That was the first time in a year that this measure, which correlates to the unemployment rate from the Labor Department, was below 40. About 12.5% of consumers viewed jobs as, quote, hard to get, up from 10.1% in April. On face value, it suggests that the jobless probably ticked up from a 2-year low of 3.6% in April. Despite consumers' somewhat unfavorable perceptions, the labor market is tightening, with the conference board noting that, quote, they do not expect labor market conditions to remain relatively strong, which should continue. They do expect labor market conditions to remain relatively strong, which should continue to support confidence in the short run, end quote. There are a record 11.5 million job openings on the last day of March and an all-time high of 4.5 million workers resigned. Inflation peaked. Consumers' inflation expectations over the next 12 months dipped to 7.4% from 7.5% in April. That fits with economists' view that inflation has likely peaked. I don't believe that. The Fed has increased its policy interest rate by 75 basis points since March. The U.S. Central Bank is expected to hike the overnight rate by half a percentage point at each of its next meetings in June and July. With prices still high and borrowing costs rising, consumers are reassessing their spending plans. The share of consumers planning to buy a motor vehicle over the next 6 months dipped. Fewer consumers intended to buy major household appliances like refrigerators, washing machines, dryers, and television sets. But the buying plans remained at levels sufficient to keep consumer spending growing and the overall economy expanding. Rising interest rates and the accompanying tightening in financial conditions left Americans worried about an imminent recession. Economists say the hand-wringing about economic downturn was exaggerated, noting the record job openings and resignations. Recessions are ultimately a loss of faith, said Bernard Yaros, an economist at Moody's Analytics. Quote, yet consumers have no fear when it comes to job security. People are quitting their jobs at a prodigious rate, knowing they will easily find another job given the record number of job openings or open job positions. Consumers this month also showed less inclination to buy a house as rising mortgage rates and record house prices eroded affordability. A separate report on Tuesday showed that the S&P CoreLogic Case-Shiller 20 metropolitan area home price index surged to a record 21.2% on a year-on-year basis in March after increasing 20.3% in February. Tight inventory, especially of previously owned homes, is driving house prices. Big price gains were recorded in a number of cities, including Tampa, Phoenix, and Miami. Strong house price inflation was reinforced by another report from the Federal Housing Finance Agency showing home prices increased 19% in the 12 months through March after rising 19.3% in February. Price gains were across the board, with notable increases in the South Atlantic, East South Central, West South Central, Mountain, and Pacific regions. With demand slowing, house price inflation will cool. Reports this month showed continued declines in sales of new and previously owned homes in April. Applications for loans to purchase a home have also been dropping. Quote, house price gains will be far more modest from here, said Matthew Poynton, senior property economist at Capital Economics in New York. Quote, we expect annual growth to slow to zero by mid 2023. All right. Got one last article here. It has to do with, comes from our friends over at First Trust, Brian Westbury. Nice guy. Met him, I think, at least once at a conference, probably back in Houston. Title of this is The Outlook for November. We are about 5 months away from midterm elections that will decide who controls the Senate and House of Representatives for the next 2 years. For the House, we think Republicans are overwhelming favorites with odds of at least 95% to reach a majority. That does not surprise me. We are so confident, or why are we so confident? First, the GOP finished the last election cycle with 212 of the House's 435 seats, so doing even slightly better should get them the majority. Second, the party not in control of the White House this time, the Republicans, usually does very well in the midterm election cycles, like the GOP in 2010 and the Democrats in 2018. Third, President Biden is languishing in the polls with an approval rating of 40 to 41%. Fourth, the GOP is winning the average generic ballot poll um, by 2 points over the Democrats. A 2 point margin is where the Republicans were on Memorial Day weekend in 2010 when they went on to win by 7 points, an election that took them to 242 House seats. We also think Republicans are the favorites to win the Senate, but not by as much. For the Senate, we think the odds of the GOP taking control are more like 85%. Why the difference? Two key factors: math and candidate quality. There are 435 House seats, and all of them require a vote. By contrast, with its 6 year terms, there are only 34 Senate races this fall that will go to the ballot box. And among those 34, Republicans must defend 20 of those seats. The Democrats only have to defend 14, which gives Republicans fewer opportunities to make gains. Meanwhile, in some states, the Republicans have had some trouble nominating top flight political talent. Well, that's not shocking. Who would want to work in politics? And unlike with House seats, candidate quality matters much more in Senate races, where people usually find out more about statewide candidates. I mean, frankly, the Senate should be elected by the state houses the way it was originally set up. The 17th Amendment is an abomination, should be revoked. The Senate was originally created to represent the state's interests, not the people. But that would require people actually reading the Constitution and understanding it. And it's not that hard. It's in English. You can even get a version that's not in cursive. With this year looking like a classic wave in favor of the party not occupying the White House, it's hard to see Republicans losing any Senate seat they hold now, with possible exceptions of Pennsylvania. Meanwhile, on a race by race basis, Republicans look favored to win in Nevada, Arizona, and Georgia, with reasonable possibility of winning in New Hampshire and the ability to take Colorado if the wave turns into a tsunami. Yeah, I wouldn't mind getting the two jackasses that are here in Colorado out there. They're just, they just do whatever the party tells them to. They don't think. It's just sad. Put it all together, and our best guess is the GOP finishes with a net gain of 3 seats, taking them to 53. What would these outcomes mean for the next 2 years? That every piece of legislation reaching the president's desk will need to have bipartisan support. Don't take us the wrong way. We are not jumping up and down with joy that Republicans will win. We could write a book about how many mistaken policies Republicans have passed. Yeah, I can name a few. What we were saying is that a tax hike doesn't get passed this year. It's not happening at all until at least 2025. A Republican takeover of the House or Senate or both would mean at least some temporary gridlock in many areas of public policy, which means no new entitlements. Bottom line is much less growth in government due to new laws coming from Congress. And that is actually my bright spot. Gridlock is the best possible thing that you can have. And hey, thanks, Tim. I saw your note here. Sorry, it took me 10 minutes to notice it. Anyways, but yeah, gridlock is probably the best thing. And that's what I was hoping after the last election. If the chicanery that possibly went down in or I guess that was Georgia. I would have liked to have seen, a split Congress where the Senate was one way and the Congress was another. That means they don't get anything done, and that is perfect. And frankly, our government does things that they're not. It's not in the Constitution to allow them to do it, but they just do it anyways because most people think that the federal government supersedes the state governments, which is the other way around, folks. The state governments are the ones who give the power to the federal government. And at any time, they can revoke that power. But hey, Again, it required people actually reading the Constitution and actually understanding it. Anyways, all right. Well, that's everything I had for today. I hope everyone has a fantastic evening. And if you need anything from me, go to dsafinancialgroup.com. All my contact information is there. And I'll be back tomorrow with the Liberty Call. Y'all have a great evening, folks.